Make Better Wealth Decisions, a podcast that explores how financial advisors' blind spots can harm your investments. I'm your host, John DeGuy, a portfolio manager with Design Securities in Toronto. In this podcast, we'll provide advice on how you can achieve better outcomes by maximizing investments and minimizing taxes. Let's put our thinking caps on as we consciously decide to get smarter about our money.
Earlier this week, I had a conversation on my podcast with a guest who talked about what he thought might happen in the aftermath of the United States election. And one of the things that came out of that conversation was that opinions are like noses. Everyone's got one, and everyone's got an idea about what it means to have the Republicans control both the House and the Senate and to have Donald Trump as the president, and what it might mean for Canada-U.S. relations, what it might mean for the economy, what it might mean for capital markets. And obviously no one knows, but this is an area where intelligent people may differ, and they can all give you a very plausible narrative about what might happen and why, which calls into question the concept of decision theory. And that's what Make Better Wealth Decisions is all about. It's trying to find ways to talk about the expected utility and probability of different outcomes when you have no way of knowing for sure what the future actually holds. So the thing that you need to think about when you're contemplating how to invest in the aftermath of the outcome of November 5th is, well, what do I think? What is the consensus? If my viewpoint is different from the consensus, why should I be smarter than the average opinion of the average voter or the average economist or commentator? What makes my insights better? And I'm not telling you that you're necessarily wrong. I'm saying you should be skeptical and you should rein in your own impulses, because people don't generally resist their own ideas. Everyone thinks their own ideas are wonderful. What we're talking about here is the application of rational choice theory. So you've got to think about behavior given the uncertainty of possible outcomes and what it all means and the knock-on effects. What's optimal? What's best? And that takes into account not only what could go right, but also what could go wrong. And not only that, but to what extent or to what degree and to what probability. Let's say there's a 60-40 chance that things go right, 60% right and 40% wrong. But if things go right, they go modestly right. But if they're wrong, they go substantially wrong. That's not a prediction, that's an example. But think about how things might go in terms of best case, worst case, and what are you doing to make a choice given the uncertainty of a whole variety of competing outcomes, all of which seem plausible at the outset. So one thing I would ask you to think about that I've been reading about lately, people are asking the question rhetorically, if the AI bubble in 2024 is bigger than the dot-com bubble at the turn of the millennium. I'm not saying the answer is yes. I'm not saying the answer is no. I'm asking you if you've thought about that. And if you have, what conclusion have you come to? And if you've come to a conclusion, what, if anything, are you doing differently with your portfolio? As we speak here in November of 2024, flows into capital market investments, into the stock market in general, and into crypto and other things have been strong, even though valuations have been extremely high. So one would think that a rational thing to do is to buy low and sell high, but by all objective standards, the stock market is extremely expensive right now. What are you doing to protect against that? I know that I, in the advice that I give to my retail clients, am trying to find ways to find products that get good returns, but that avoid those high valuations in order to avoid the possibility of a significant drawdown if in fact there is a bubble and that bubble does in fact burst. That may or may not come to pass. I've been expecting it for some while and it hasn't happened yet. And so one of the things that I would say is I may be wrong, but there is a rationale behind what's being done. The important thing is that you don't just blithely go about your business investing the way you always have without, at a minimum, stopping to think and reflect upon what you're doing and why you're doing it. And then and ideally, based on what our guest was saying, write it down and check what your rationale was and what your thinking was against what actually happens as time elapses. And if nothing else, it will probably give you a sense of humility, but with a little bit of luck, it'll make you a better investor as well.
John DeGooey is a portfolio manager with Design Securities in Toronto. The views expressed in this programme are not to be construed as specific advice. It is recommended that you consult a qualified advisor before taking action. His books, The Professional Financial Advisor 4, Stand Up to the Financial Services Industry and Bullshift are available through Amazon and in bookstores throughout Canada. You can reach John at 647-STAND-UP. That's 647-782-6387 or at jdegooey@designedsecurities.ca.